Ever felt like the best investment opportunities were reserved for the super rich? You hear about these exclusive deals, these private equity funds that seem to generate incredible returns, but the entry ticket is $1 million or more. Well, what if I told you that the velvet rope is starting to come down? What if the world of private equity, once a fortress for billionaires and institutions, is slowly opening its gates to everyday investors like you and me? Stick around, because today we're diving into how the game is changing and why you might be able to get a piece of the private equity pie sooner than you think. So, first things first, what exactly is private equity? In simple terms, it's investing in companies that are unlisted on a public stock exchange, like the New York Stock Exchange or the Nasdaq. Think about it. For every massive public company like Apple or Amazon, there are thousands of promising private companies. These could be innovative tech startups, family-owned businesses looking to expand, or established companies that a private equity firm thinks it can improve and make more valuable. Traditionally, private equity firms, or pay firms as they're called, raise huge pools of money from what are known as institutional investors. Think pension funds, university endowments, and insurance companies, and from very wealthy individuals. They use this money to buy controlling stakes in these private companies. The goal isn't just to sit back and watch. Oh no, it's a hands-on approach. The PE firm gets actively involved in the company's operations. They might bring in a new management team, streamline processes, expand into new markets, or help develop new products. They work for several years, typically 5 to 10, to grow the company and increase its value. Then comes the exit. This is when the pay firm sells the company either to another company, another pay firm, or through an initial public offering, an IPO, which takes the company public. If they've done their job right, they sell it for a lot more than they paid, and everyone who invested in the fund gets a handsome return. The potential for high returns is what makes private equity so attractive. Because these firms have direct control and can make significant changes, they have the potential to generate returns that can often outperform the public stock market over the long term. But here's the catch, the one that has kept most of us on the sidelines. The barrier to entry. Historically, to invest in a top-tier private equity fund, you needed to be an accredited investor or a qualified purchaser. These are official classifications with high income and net worth requirements. And even if you met those, the minimum investment, the check you had to write, was often $1 million, $5 million, or even $10 million. That's a world away from buying a few shares of a stock on Robinhood for $100. So, why are we even talking about this today? Because a seismic shift is happening. The walls of that exclusive fortress are starting to crumble, and it's thanks to a few key factors. The biggest one, technology. Fintech platforms and new financial products are changing the game. These platforms are acting as aggregators. They pull smaller amounts of money from a large number of individual investors to meet the massive minimums required by the big pay funds. Think of it like crowdfunding for private equity. Instead of one person writing $1 million check, 1,000 people can each put in $1,000 to get into the same deal. This isn't just a theory, it's happening right now. New regulations and innovative fund structures are making it possible. We're seeing the rise of things like interval funds and feeder funds designed specifically for retail investors. These funds are registered with financial regulators, providing a layer of oversight, and they are built to accept smaller investment amounts. For the first time, you might be able to invest in a private equity strategy with a minimum of $25,000, $10,000, or in some cases, even less. That's still a significant amount of money, for sure, but it's a world of difference from $1 million minimum. It moves private equity from the realm of impossible to aspirational for a much larger group of people. So, why would the big private equity firms want our smaller checks anyway? Don't they have enough money from the big institutions? Well, it's about diversification of their own funding. Relying only on a handful of massive investors can be risky. By opening up to a broader base of individual investors, they create a new, vast, and more stable source of capital. It's a win-win. They get access to trillions of dollars in retail investor wealth, and we get access to an asset class that was previously offered. The giants of the industry, firms like Blackstone and KKR, are actively creating products and funds specifically for this new market. When the biggest names in the business are making moves like this, you know it's not just a passing trend. It's a fundamental change in the landscape of investing. Now, before you get too excited and start searching for private equity funds to invest in, we need to have a serious talk about the risks. This is incredibly important. Private equity is not like buying a stock that you can sell tomorrow if you change your mind. Your money is typically locked up for a long time, often 7 to 12 years. This is called illiquidity. You cannot easily get your money out before the fund's term is over. That's a huge commitment, and you need to be absolutely sure you won't need that cash for a very, very long time. Second, the fees can be higher than what you might be used to with mutual funds or ETFs. Private equity funds typically operate on a 2 and 20 model. This means they charge a 2% annual management fee on the assets they manage, and they take a 20% cut of the profits, known as carried interest. While these new retail-focused funds might have different fee structures, you need to read the fine print very carefully and understand exactly what you'll be paying, as fees can significantly impact your net returns. And finally, there's no guarantee of success. While the asset class as a whole has performed well historically, not every deal is a winner. Some investments will fail. That's just part of the business. You are investing in private companies which are inherently riskier than large, stable public companies. The potential for high returns comes with high risk. This is not a get-rich-quick scheme. It's a long-term, higher-risk, potentially higher-reward investment that should only be a small part of a well-diversified portfolio. It's for your play money, not your "I need this for retirement in 3 years" money. So, how can you, as a beginner, start to explore this. First, educate yourself. Read books, listen to podcasts, and watch videos like this one to understand the fundamentals of private equity. Understand the different strategies, like venture capital, which invests in earlier stage startups, growth equity for expanding companies, and buyouts for mature businesses. Next, check your own financial situation. Do you meet the accredited investor requirements? Many of these new platforms still require it, though the rules are evolving. The definition can be complex, but it generally relates to having a certain level of income or net worth. Be honest with yourself about your risk tolerance and your time horizon. Can you truly afford to lock up this money for a decade? Then start researching the platforms. There are several reputable fintech companies that now offer access to private equity, private credit, and other alternative investments. Look into companies like Moonfare, YieldStreet, or Fundrise, which each have slightly different models and minimums. Scrutinize their offerings. Who are the underlying fund managers? What is their track record? What are the fees? What are the liquidity terms? Do your due diligence, just as you would for any other major financial decision. Don't just jump on the first ad you see. The democratization of private equity is one of the most exciting developments in finance today. It represents a move toward a more inclusive investment world where the best opportunities are unjust for the ultra-wealthy. The minimums are dropping, the doors are opening, and the technology is making it all possible. But with this new access comes new responsibility, the responsibility to educate yourself, understand the risks, and invest wisely. This isn't a replacement for a solid foundation of stocks and bonds in your portfolio. Instead, think of it as a potential high-octane satellite to your core holdings, a small allocation that could potentially deliver outsized returns over the very long run. The world of private equity is complex, but it's no longer a secret. It's an evolving landscape, and for the savvy, patient, and well-informed investor, it presents a brand new frontier of opportunity. Keep learning, stay curious, and maybe, just maybe, you'll find a place for it in your own financial future. Thanks so much for watching today. If you found this breakdown helpful and want to learn more about navigating the world of modern investing, make sure to hit that subscribe button and turn on notifications so you don't miss our next video. Drop a comment below if you have any questions or if there are other complex financial topics you'd like us to break down. Until next time, invest smart and stay informed.